Hello and thanks for joining us. My name's Ian Stroud.
And my name is David Malone, and this is Hyperland.
Well, since we did our first banking podcast, there's been further information that's come out.
Yeah, I thought it was worth having a quick look at the continuing fallout of Signature and Silicon Valley Bank and now First Republic.
Yeah.
And a lot will be written about it, but there was just a couple of things which struck me. First Republic is quite a big bank.
Yeah.
It's 15th largest in the States.
That's not medium.
No, that's a pretty big bank.
Yeah.
And also the Silicon Valley collapse, I can't remember. I think it's one of the largest collapses that there has been. In fact, it was only Washington Mutual back in 2008, which was a larger bank collapse.
Yeah.
Now, I mean, other big financial things have gone down, but Silicon Valley Bank's collapse is big.
It's all significant, but they're now sort of trying to explain it a bit better than they had before, perhaps. Not about rumours that were going around and runs on banks. That seemed to be...
Yeah, and there's something to that, but it's the nature of the run on the bank. Because I don't know, I think most people, when they hear well, there's a run on the bank, certainly in this country...
Yeah, we think of Northern Rock, don't we?
Exactly. And so it's Mrs. Miggins down the corner and your Aunt Sally and the bloke from the pub, and they're all outside saying, "Can I have my £5 back, please?"
Yes.
Well, that's not the nature of this. And there's something interesting about it, because there was some talk when it went down about bank deposit insurance. And
I remember you selling us the exact thing with the trusts.
Yeah. Okay. So it does link up in a really interesting way, because bank deposit insurance in the States, I think, was $250,000. That's the amount that you're insured at.
Yeah.
Here it's $85,000, I think.
Yeah.
Right. Now, I don't know anyone who has £85,000 in the bank. Do you? I mean, anyone at all?
No, but I'm sure we both wish we did.
Yeah, but have you ever met anyone that had more than £85,000 in the bank? I think I've met two people.
Maybe one or two. Yeah, I think.
So most people...
They were running away at the time.
Yeah. Most people, that kind of insurance is fine. For 80%, probably more, of the population, having insurance up to £85,000 and is fine.
Yeah.
So why would you need to raise the insurance level?
Oh, to the 250
above that. I mean, they were talking about insuring it for the full cost. In fact, they have promised that in the States for Silicon Valley Bank. So I had a quick look at that, and banks differ on the number of uninsured and insured depositors. Insured depositors means people who've got less than £85,000 in the bank, or less than $250,000 in the bank. If you've got much more than that, you're counted as an uninsured depositor. And some banks, virtually all, I mean, like a little local savings and loan or little local bank, nearly all its depositors will be insured. So even if the bank fell down, under present legislation, you would all get to, all the ordinary people will get their money back.
Yeah.
Interestingly, Silicon Valley Bank, 93.9% of its depositors were uninsured.
Yeah.
Okay, so nearly everyone that banked there was banking very large amounts of money.
More than $250,000.
A lot of their clients were Silicon Valley startups and tech companies.
Yeah.
And they were depositing very large sums of money because of the very large amounts of cheap money that have been floating around.
When these rumours were going out, there were quite a few interviews with companies over there sort of saying basically, we had 5-6 million in there. I heard these rumours, and luckily we can do everything online, and I just took it out. So that multiple cases of that is the run. But like you're saying, it's not 50 quid, it's multiple millions being taken out at once. I hadn't, well, I mean, with the one that's this weekend possibly going under.
First Republic, it's not possibly, it's going.
Yeah. No, but with them, I hadn't realised how big they were.
Yeah, I mean, it's a case of and
that's
it's gone.
I mean, one
large.
One little thing that probably isn't helping the conversation too much, apart from the fact that they're taking the money out and they're putting it somewhere, and I assume they're putting it into the big banks. So all of this is only going to be helping the larger banks.
Well, it's certainly going to mean there's going to be a further consolidation.
Yeah.
So the big banks will get even bigger because Morgan Chase put 70 billion in to prop them up.
Yeah.
This is into First Republic. It hasn't.
Yeah.
Now that 70 billion, they will get back. The federal government will make sure that doesn't disappear.
Yeah. And JP Morgan put in some into the Silicon Valley one. Well, that went.
Could well be, and a consortium of 11 other banks. But there's another part to this, because if it had just been the case that Silicon Valley had, nearly all its depositors were big, that's a problem. It means they can whip the money out. But the other interesting part is, how had they invested that money, all these deposits? And it turns out that they'd invested it in what are called hold-to-maturity securities. So in other words, a fixed income security, which can be a bond, where you can't get your money out.
Right.
And it might be locked in for, say, 10 years.
Yeah.
In the category of their books, it says loans and hold-to-maturity securities, how much of the deposits from their big depositors have been invested in that way. And the thing is, your money's locked in, right?
Yeah.
You can't just go, quick, I need the money back out.
Yeah.
So the bank couldn't just get the cash back out for their clients. They would have had to have sold the security, the hold-to-maturity security that they had bought with that money. And the value of that has been going down because interest rates have been going up. So as interest rates go up, the value of
what they've invested in is
going down because of the particular nature of those investments, which is these hold-to-maturity government bonds, for instance. All right, so they couldn't get the money out quickly, and if they had to have a fire sale, the money would go down even further. So they would not be able to reimburse all of their clients, and haven't been able to reimburse all their clients. So they're now insolvent. But so you might think, okay, what other banks? How many is that very unusual? Where a bank has large depositors and has tied up their deposits in illiquid investments. Well, Signature Bank that went down, they had 89.7% of their depositors were uninsured, and 93.3% of their investments were also in these. Okay, so there's another. First Republic, only 67%. That's still pretty high of their depositors uninsured, and they had 110.6%. Now, I can see you frowning. Welcome to the world of banking.
Is this called leverage?
Very probably, yeah.
Right.
We can't. I mean, I haven't got access to anything. I can't drill down in that.
Yeah.
But I was glad to see that both of your eyebrows shot up to the top of your head like, what? Well, that is banking for you.
Yeah.
But interestingly, City National Bank, 70.4% of their depositors are uninsured and 93.6% in H2M securities and loans. So they haven't gone bust yet.
Yeah.
But they're in the same predicament pretty much as Signature. So if you were going to say, might this spread? I'd be worried if my money was in City National.
Well, maybe,
now, I don't know. They might be in fine shape.
Yeah.
Your Honour. When you just look at those figures, and they're separate, there may be dozens of other figures we don't have access to, but just those two, City National fits the profile of banks that have recently gone under. And City National is a subsidiary of Royal Bank of Canada,
right?
Based in Hollywood, and is the bank to the stars.
Yeah.
So it'd be interesting to see what happens with them, whether this profile of banks spreads. In which case, City National, I'd be looking at taking my money out. So that's pretty interesting. And then you've got CIBC Bank of USA, 87.1 in these long-dated securities, 73% uninsured.
So I mean,
So in other words, I'm saying there's a profile
yes,
of banks,
yes,
other banks to watch.
What you were pointing out to me in the first podcast that we did was the link between the banks and the insurance companies.
Yeah, it's a weird one, and I wrote about this years ago because there are these weird tie-ups between banks and insurers. Particularly, you get two kinds of trade. You get regulatory capital relief, and then there's another trade called liability-driven investment.
Yeah.
Both of these worry me. Basically, regulatory capital relief is the way that insurance companies will buy the risk of risky bank deals. So the bank keeps the deal,
yes,
even though the regulator says, well, this is very risky, we don't want to have it. But the insurer says, fine, well, we'll take that risk. We'll insure the risk. But what it means is that the banks are still doing risky deals, but they've removed the risk from the place where the insurers, where the regulators shine their light. And now it's gone somewhere where the regulators aren't looking.
Yeah.
So that's just me going, oh, I'm just worried. And, I just do this as a private citizen. I have no insight. So that could be rubbish. You might just think, someone from the banking industry might go, oh, what does he know? He's just some Herbert who lives in the north of England. Fair enough. Okay. That's quite true. But I was interested that after Silicon Valley went down, the Swiss regulators said, oh, we're monitoring our banks and our insurers. And I'm pretty sure they are now after Credit Suisse went down.
Yes, I was going to say they had Credit Suisse.
But it's interesting that they're looking at both. Because there is this tie-up. There is the tie-up between banks and the non-banking sector, which includes insurers and pensions. And this is how it might impinge on you and me. These vast insurance companies are also often the pension companies, which is where you and I might come a cropper. And there is how there's that list of G-SIFIs, the globally important systemic,
I've got it up in front of me.
Global systemically important financial institutions. Well, there is a G-SIFI list for insurers.
Oh, I didn't know.
Well, it got a lot less press coverage at the time.
Yeah.
And this tie-up between bank instability and insurers, and then in my sort of scattergun mind, and this is the way I think about it, because I'm not a professional and I just don't have access to all the facts and all of the papers, reports which people on the inside do. So I can't compete, and they know far more than I do. I tend to think more sideways.
Yeah.
And the old quasi-Kwarteng list trust fandangle that happened, I was just interested in the fact that headline is very next day is, Bank of England has to step in
to prop up our pensions.
Pensions, and you think, wait a second, where did pensions come into this?
Nothing mentioned about that.
Why suddenly? Why are pensions suddenly at risk? And how can pensions be at risk? Well, pensions buy a lot of bank investments. I mean, there's a tie-up there.
Yeah.
And the worrying thing about pensions is that other financial thing I mentioned, liability-driven investment. I see a creeping into pensions of the same kind of lack of prudence that basically has bedeviled the banking sector since 2007, at least since then. And it's worth just mentioning the FDIC report on Signature Bank. It said, poor management, pursuit of rapid, unrestrained growth with little regard for risk management.
Well, that's just pointing the finger. That's
but it also does make you. That's like saying, about someone who drives, says, bad road handling, pursuit of unrestrained speeding around the roads, and little regard for brakes. That sort of person would be locked up immediately. And both of the reports for Signature and SVB said management prioritized growth and ignored basic risks. So, and this is, it basically just says to me, nothing's been learned. That you would have read those reports in 2008, and 9, and 10, and onwards.
Yeah.
So it's still going on.
But the linking with the pension, I mean, that's worrying. I
think it is worrying. And as I said, this other thing called liability-driven investment, without going into it too much, basically, because we've had this long period of low interest rates, it's really crippled the pension industry, because the pension industry says, invest your money with us, and by the time you're 65, or the way the law keeps changing, by the time you're 106 and they finally let you retire, carrying a hod of bricks until you're in your 90s, they've often touted sort of during the financial times of crisis, 8% growth of...
Yeah, of course.
There's no way that they can deliver. And it's difficult when you've got really low interest rates for the pension companies to deliver
that growth,
a pretty decent growth on the money you're investing, such that it's worth you
investing.
Investing with them at all. And so there has been a pressure for them to take more risks.
Yeah.
And I'm sure there's 101 pension lawyers who are saying that's simply not true. And we might well hear from them. But the whole basis of liability-driven investment, I have to keep switching the page to make sure I get that right, is basically leverage for pension companies.
Okay.
And I don't like
leverage.
Bringing those two things together, pension and leverage,
Yeah.
makes you feel a bit wibbly-wobbly, doesn't it?
No, just leverage on its own.
Yeah, but I mean, if they want to leverage the car that they're buying, knock yourself out, mate. But my pension, not that I have a pension, but don't leverage pensions, okay? And basically what they're doing is it's some clever financial jiggery-pokery offered by companies to pension companies, and they say, we will use derivatives, the lovely word, to allow you to take some of your money, which you should be holding for your regular payouts in the pension, and we will use some leverage so that you can reinvest some of that. So they are now leveraged.
Yeah.
So now when you get these things together, where banks are collapsing because of idiot management, and the Swiss are saying we're going to monitor our banks and our insurance companies, and the insurance companies and pensions are closely related. And we're finding that we've got, and there have been quite a number of reports on this use of, let me just get the name right again, liability-driven investment, saying, we're not sure. And some of the reports have said, no, they're well capitalized and it's fine. And every time there's a report saying it's well capitalized and it's fine, my red lights start flashing for me.
Yeah.
So they are links. So I'm not an expert, and I am linking one thing to another. But when you end up with banks collapsing because of poor management and very poor management, and the Swiss saying we're going to monitor our banks and our insurance companies and pensions linked together, and I know that there's lots of leverage in pension companies, it leads me to think,
oh shit!
If this spreads, and CEO of Man Investments said he thinks there's going to be more bank collapses, and I tend to agree with him.
Yeah.
And the bailout of First Republic, the Americans public is going to bail them out, and they are going to, once the big banks take the viable parts of the bank.
What's left?
We will be picking up the usual old shite.
Yeah.
And in 2008, the threat was we have to bail them out however much it costs, because otherwise, if all the banks go down, you're going to lose your mortgage. What's going to be, if this continues, what threat would be the one that you use? And what worries me is if they... Exactly that.
Yeah.
Exactly, Ian. That if they just said, oh, you've got to bail them out because you might lose your mortgage, I think some people might just go, you know what? That's the second time you threatened me with that. Not happening. But what happens if they say, oh, your pension company could fall over and your pension will go? And we'll be back with people going reluctantly, oh, all right, well, maybe we do have to bail them out. And that would just be awful.
Yeah.
Anyway, that's my
update. Thank you for that, mate.
Sorry about that.
Thanks for listening. If you enjoyed it, please leave a review.
And if you'd like to leave a comment, which would be great, we've set up a Hyperland Substack. So go to Substack, look up Hyperland, leave us a comment. We'd love to know what you think. And if you've got ideas that we should cover, that would be great too. Thanks a lot.
Brilliant. Thank you.